So what I want to do is just introduce to you the conceptual framework of accounting. And I'm going to tell you first, the most important thing to note about the conceptual framework is that it is not part of the GAAP standards. It does not have what is known as authoritative support. So the conceptual framework is not part of your GAAP standards and does not have what we call authoritative support. The conceptual framework really provides the theoretical foundation for not only the standards we issue, but the day-to-day practice of accounting. So the actual conceptual framework objectives are, first of all, to guide the standard setters in not only developing new standards, but justifying existing standards. So the codification's main objectives are to guide guide the development of new standards. So we want to look at we also find justification for existing standards. As we guide the development of new standards, provide justification for existing standards. Also provide you with a way to handle day-to-day issues not covered by the standards in a consistent fashion. So for example, if you are now auditing a company and you look at a transaction that doesn't really fit into a particular standard, you could fall back in the conceptual framework to justify your decision on how to account for it. Now, this is much more likely in the international standards. So the IASB uses the conceptual framework a lot more in this way than we do in the United States. And really, it helps promote user confidence, that users know that accounting standards are developed consistently by falling back on this framework. Now, we're not going to go through the framework in that much detail. Actually, I need to just bring this up for now, because it's hard to see this. But the conceptual framework, when you look at it, it's got several components, and we're going to do this in great detail in intermediate accounting, but just for this course, conceptual framework consists of a couple of parts. One, it's the objectives, or objective, I should say. So, number one. And there are a few other pieces, but this is what we're going to look at predominantly today. So the conceptual framework will include the objective of financial reporting, the qualitative characteristics of useful information. So what does useful information look like? And measurement and valuation. Principles. So these are parts of the conceptual framework that we look at. Qualitative characteristics, objective of financial reporting, and recognition and measurement principles. Actually, recognition. So I'm squeezing this word in recognition, but that's all. Recognition, measurement, and evaluation principles. All right, so now, these are the objectives of financial reporting, or the objective of financial reporting. It is really an information objective, and it's to provide information, as we know, that's useful to investors and creditors and other decision makers. I think we established that last week. It's also important to provide information to allow investors and creditors to assess the amount, the timing, and the uncertainty of the cash flows of the firm. Now, when we look at the second bullet, if you have to value anything, just think about it, even on a personal level. You're going to be thinking about your ability to generate cash. And when that cash is going to come in, how much, and what's the risk involved with that. And that's the way we value an entity. We try to forecast their cash flows. We would then think about the timing, when they're going to occur, and what's the risk. And that risk, if you ever worked with discounted cash flows, we'll do a little bit about, a little bit of that here. We would discount that back to the present. So we'd have to think about the amount, the timing, and the uncertainties. And by the way, that statement, we talked about the primary financial statements. Well, the general purpose financial statements will help satisfy this objective, and that statement would be the cash flow statement. That would be the cash flow statement. So the cash flow statement is going to be now not only the cash flow statement, the income statement helps us too. So predominantly, all statements will help, but those statements will assist there. And of course, we've got information about economic resources and financial claims. What are economic resources? What's another word for that? And this is a big problem in accounting. Lots of synonyms. Assets and financial obligations or claims or liabilities. So we have to look in terms of the company's asset base and their liabilities. And of course here, primarily that would be found on what statement?
Balance sheet.
Balance sheet. So what I'm trying to show you here is that the general purpose financial statements are designed to help achieve these objectives. So as we start in a few minutes to get hung up on accounting equation, debits and credits, just think about the broader picture and to really understand that the financial statements are designed to help achieve certain objectives, cash flow projections, information about liabilities, information about economic resources, and of course, financial performance. And that's going to come from this up. Financial performance, of course, is pretty much the income statement. So the general purpose financial statements will help us achieve those objectives. And again, what we're trying to do is allow decision makers to monitor the performance of the company, effectiveness, efficiency, and we talk about stewardship. Does anyone know what this? I mean, ethics, of course, will have to play a big role. But what is the stewardship issue? Does anyone know? What does it mean? Anyone? Any idea? Yeah.
Integrity?
Well, integrity, yeah, but who's the steward for who here, basically? I mean, someone is watching the assets.
I was about to say management.
Yeah, management is really responsible for the use of the assets that you as stockholders provide. And that's what we mean by the stewardship function. It's kind of an old term, but it's starting to come back in the sense that you invest in a company, your assets are on the line, but management is responsible for the way those assets are managed or handled. And they're responsible for generating cash and income flows and properly managing the assets and liabilities on the balance sheet. So those are, in general, it's an information objective. The overall objective is to provide information that's useful in making decisions. And these are more of the sub-objectives, or that really tie back to that information objective. And remember, again, going back to Pete, the question you had about tax, the objective of financial reporting is an information objective, a decision-making objective. The objectives of taxation are to raise revenue, achieve social and economic objectives, which therefore justifies the difference in accounting. There are differences in accounting for both work and tax. Now, that's the objective. Any questions on the objective and how that will come into play with our financials? We'll see that I'll keep going back to it if we could, whenever possible. Next, qualitative characteristics. Now this has changed a little bit. I'll update you when we get to the intermediate course, but the model is essentially the same. What are the characteristics of accounting information that make it useful? And before we provide any accounting information, the benefits have to exceed the cost. So when you look at this model, we're saying, well, you know what? I have to decide, now I'm a standard setter, I have to decide whether or not to provide information on pensions, for example. Or what do I do with stock options? How do I treat it? How do I measure stock options? If I measure stock options, what are the benefits and what are the costs? What do you think is easier to measure up there, the costs or the benefits of providing useful accounting information? Right, Dwayne, you said cost. Yeah, cost. Right. I mean, obviously, the cost of developing the standard, the cost of implementing the standard, interpreting it, modifying it. There's lots, when I say cost of implementation, you have to train your staff, new computer systems have to be put into place, so new information systems. So the costs are much higher than the benefits. The benefits have to be projected or estimated. In many cases, those benefits are miscalculated. Years ago, when inflation was double digit, and this was down probably maybe late 70s, early 80s. I remember my first mortgage was like 13%, 12.75, and it was a bargain. A couple of years before that, mortgage rates were in the 20s, 20%. Now, of course, if you had money in the bank, you were getting, almost doubling your money quite often. But the interest rates were very high, and the standard setters thought that we needed to account for inflation. Now, we don't have price level adjusted accounting in the United States. In countries where there's hyperinflation, they do price level adjust their financials. And we will talk a little bit about that in advanced accounting, but we don't have price level adjusted statements in the United States. What happened was back in the late 70s, early 80s, the FASB decided that we should provide supplemental information, not the regular financial statements, but behind the actual statements, price level adjusted statements. And we would do that in several different ways. We'd either use a price index, or we would get market values or inflation-adjusted values for these assets on the balance sheet. Bottom line, nobody used it. The standard went away. It just, companies said it's too expensive. How do you get, for example, how do you get the fair value or the current value of a plant? Actually, one of my clients was a plant in Jersey City. They manufactured roofing products. The plant was probably built in the 1800s and had wooden gears. How do you replace that? What's the replacement cost? The SEC thought replacement cost was the way to go. How do you replace that? So if you think about it, there's nobody out there that's going to be able to give you a good estimate. And as a result, the standard went away. So they obviously miscalculated the benefits of that replacement cost information or that inflation information. It was not useful to the market, and we stopped providing it. Then understandability. That is, as we'll talk about in a minute, you got all these definitions right behind you, but that essentially is the ability of a reasonably informed user to perceive the usefulness of the information. And then, of course, in order to be useful information, primary qualities, we not only use the term reliability anymore, we use it as representational faithfulness and relevance. And there's always, as I was saying to you, a trade-off between relevance and faithful representation. And we have to deal with that in all cases. We have to deal with that trade-off constantly. For example, when you look at what's relevant, it's something that's timely, you get it in time to make a decision. It has predictive value, so you can forecast future cash flows. It has feedback value. When you get the financial statements next year, you know if your projection was correct or incorrect. But when you look at relevance, timeliness, the faster you get the information, the more relevant it is. But the quicker you get it, the less representational faithfulness you have, or the less reliability. So an annual report, actually, well, we're going to talk about this time period assumption in a minute. The only way you really know the true profitability of a business is to wait until it's liquidated. But because of the demands of stockholders, you can't wait till the company terminates. So we have to break the business up into artificial periods, and of course that reduces the reliability of the information because we have a lot more estimation. Verifiability, the ability obviously for us to come to an agreement, a consensus agreement that the numbers are correct. All of us would obviously look at that together and come up with the same decision. Neutrality is free from bias. Comparability and consistency we'll define in a minute, but this last one I wanted to make sure we understand, and we're going to do all these definitions in just a second, but materiality, that's very important because it is the level of significance of the economic event. And essentially, if an item is not material, it does not have to be accounted for in accordance with GAAP. So if you have a very, very insignificant transaction, not following GAAP won't be a problem because it will not have any material effect on the judgment of a user. So the question always in the mind of the accountant is, if I report this in a different way than prescribed by GAAP, or if I don't report it at all, if I just leave it off the statements, maybe just disclose it, what is the effect on the decisions that would be made by a reasonably informed user? Is that going to affect their judgment? And if the answer is no, you can leave that off of the statements. So this, in general, will give you the idea of what are the characteristics of what information should possess. So we've already talked about the benefits and cost. Materiality, again, the effect is not significant enough to influence the judgment of a reasonably informed user. Now this one is kind of tricky. You got to be really sure that it's not significant. You don't have to comply with GAAP if the effect of the event is not material. Not material. And again, understandability, that's the key to this entire qualitative characteristics, that the information should be presented in a way that a reasonably informed user can perceive the decision useful. Yeah.
What's the distinction between benefit and cost and materiality?
Okay. The materiality, okay, so let's say that you decide that you need to measure a transaction by using some type of financial model. So there's a transaction that takes place. So I'll give you an example. You're going to buy inventory from a certain supplier, and you sign a contract, you're now obligated to buy this inventory from the supplier. Would it benefit the individuals that are using the statements more than the cost of disclosing the transaction? So you probably say, well, yeah, somebody would need to know I'm buying this inventory. However, if the inventory is a very insignificant portion of the company's total assets and will have almost no effect on their income and cash flow, then you may not have to disclose it. So something could be beneficial, but yet the benefits are so small that the cost may be much greater, and you may not disclose it. Or it may be very easy to disclose, and there's going to be some benefit, but if it's not that significant, then well, maybe you're looking at the benefits, they're there, but they're not extremely important. All right, good question. Any others? Oh, yeah.
Is what we would reference to materiality, is that why goodwill's gone back and forth? Because it's not considered material? Because I know you talked about that in the last class.
Yeah, no, the issue with goodwill is whether or not it loses value on a, so when you amortize something, you just, let's say, take $100 and divide it by, let's say, 10 years, right? So $10 a year is the loss of value. That's what we mean by amortization. The question is, does goodwill lose value on that very systematic way? And probably not. Now, how does goodwill lose value? Well, we don't know unless we examine. And what goodwill really represents, of course, is the reason why, in a merger, you're willing to pay more than the fair value of the company. So let's just take a home purchase. So you're going to buy a house, and you want to get a house that's close to a good school district for your children. So you're willing to pay a premium for that house. Now, the house might have a fair value of $500,000, but because of a bidding war with a couple of potential buyers, you wind up paying $550,000. So you paid $50,000 more over the market value of the house. That's the goodwill to you. And goodwill only really applies to you. And the question is, how long does that goodwill last? Well, does it last as long as your children will use the school district? So maybe you want to write it off over that period, but maybe we can't judge. Maybe that goodwill you think is going to apply to somebody else. So that's going to buy your house. So you see it as a positive value that's going to last as long as the home is in place. So do we write it off or not? And that was the question. And only if it lost value, only if you knew that something happened in the area where they found, let's say, toxic waste, and now all of a sudden, well, gee, the house isn't worth as much, and you'd have to write it down. So the question always was whether or not goodwill is an asset that loses value systematically, or is it an asset that's tied to the existence of the business as a whole? So if somebody bought Apple and paid millions of dollars over their fair value, that premium that they paid is tied to the existence of Apple. As long as Apple's in business, that goodwill should not go away.
Can you just give a quick example of a piece of information that wouldn't be large enough to affect? Yeah, like would it be just like a small asset, like office supplies?
Okay, good question. What is materiality? Does anyone know how to measure materiality? Cost, but is it going to be a relative or an absolute number? Accountants don't have an answer either. So what's material sometimes is 5% of net income. It could be 20% of total assets. Now I can give you a perfect example. When I was auditing I worked for two big four firms, and when I was auditing for one of them, they used to have a system that at the beginning of the audit, they would pop everything into computers, and yes, there were computers when I was auditing. They pop everything into a computer system. The computer system spits out a number, $300,000. That's the number. Put that in your head, write it on a sticky paper, put it in your pocket, whatever it is. That's the number. You see a transaction above $300,000, it's material. Anything below that is not material, and that was for a large company. Now that same $300,000 is pretty material to me. So, it really depends. It's a relative concept. Yeah, and what companies will do. Now I'm not saying they all, but this particular CPA firm happened to be really good with statistics and the math side of it. So they would put in the inventory, the sales, the plant assets, and then pop out that number. And that was the number of significance. Now, when you're around that number, of course, you would talk to the managers or partners and say, look, we're at 250. What do you think? And by the way, is materiality only, I'm going to get to your question in a second, Harvey. Is materiality only a quantitative piece of information? Could it be qualitative?
I think so.
Yeah.
If there's a pending lawsuit, we need to know.
Yeah, like if something happens during the year, but it hasn't been, we talked about when a transaction should be recorded or not. I may be sued. My company might be sued. And litigation is starting. I'm not sure what's going to happen. The outcome is uncertain. We talked about, the lawsuit with the musician the other day. Maybe I should disclose that because that's material information. That's material information. It could influence somebody's judgment. So you can influence somebody's judgment with numbers or with information.
Is materiality based on individual transactions or?
It's based on a single event or transaction relative to the rest of the company's financial position.
So if the company you were auditing had 100 of these transactions that were 200,000.
Yeah, obviously it's, we're talking about a special type of event. Like if you're buying inventory every week and the inventory is $1,000, it's not significant individually, but in aggregate it is. So you would aggregate inventory. So sometimes, like I'm talking about like a litigation, that's a one-time event. But in terms of day-to-day transactions, there's no question that would have to be rolled up into a single account. Okay, good questions. Any others on the concept? So again, to answer your question, a very good one, is materiality is a relative concept. It's going to depend on the company's financial position, the transaction relative to financial position, the nature of the event. What you don't want to do is get caught not disclosing a lawsuit. Typically, I know when companies are under litigation, in many cases, they don't wait. They do disclose, and they might say that based on the advice of legal counsel, we do not believe that this litigation will have a material effect on our financial statements. Then, if you had more information, maybe some numbers, you might have to give a range of possible damages, but you don't want to be caught without disclosing that. At least letting the stockholders know that the litigation is in process. Yeah.
Some software companies, they don't have a real products for software, lots of
For patents and things like that, yeah.
Yes, it's just confidentiality or how they count it. It's
Yeah, if you look at like Microsoft or Apple or any of these companies, their footnotes are loaded with potential litigation for patent infringements.
only them.
Yeah, they're either suing or somebody's suing them for some type of patent infringement, or pending a patent pending. Okay, any other questions? Right now, a couple other terms that we want to make sure we get. We know about relevance and faithful representation, and I'm just going to go with the textbook terms for now. These have changed a little bit. So in order to make a difference in a decision, you have to have relevant information. It has to be timely. It has to have predictive value, so you have to be able to predict the future outcomes. We talked about the cash flow projections earlier, and feedback value. So next year, you made a projection. This year, information could validate or refute that projection. When you look at reliability, it's really free from error, free from material bias or any bias at all. When we look at the idea of idea of reliability, we look at faithful representation, and that has to be verifiable. That means there's a consensus decision. So if you and I looked at a transaction, we both agree to the valuation. And neutrality, of course, is free from bias. Now, we always trade off in accounting. There's lots of trade-offs between relevance and faithful representation. Well, let's call it reliability for now. So we talked about quarterly statements versus annual. Quarterly statements are more relevant but less reliable. When you look at a 10Q is unaudited quarterly statements, but the market wants them. So you provide quarterly statements, they're less reliable, but the market knows that the word unaudited is right on the face of that statement, so let the buyer beware. Right? So you know they're unaudited, but you're going to use them as a guide for future projections. Another trade-off is going to be fair value. We'll see this in a minute. Fair value versus historical cost. So if I look at a set of financial statements from, let's say, the UK, and they're using IFRS, their buildings could be at fair value. In the United States, we can't do that. We keep them at historical cost. What's more relevant, the fair value or the historical cost? Now, let's think about why you would use the statements. You may want to invest in the company. You may want to buy the company. So what's more relevant to you, the current fair value or the cost?
Fair value.
Fair value. What's more reliable? The cost. The fair value has less reliability in that case because it is based on an appraisal value. I may get a different appraisal than you. Now, when we look at securities, however, publicly traded securities, you don't really have that much of a problem. And in the United States, we've gone to that point where a publicly traded security, generally, we have others too, we have different models which we'll talk about, but if I'm holding 1,000 shares of Apple, I can tell you this afternoon when the market closes what those shares are worth. And that's a fair value, and I can put that on my balance sheet. And that's probably as reliable as the day I bought it, the price I paid. Because it's a quoted price, and all of us would agree, we could verify it. Right? All of us would agree if I gave you the closing price today, all of us would agree, we'd have a consensus, and it would be free from bias because it's a marketplace that is very active. It's coming from an active and frequently traded market. So again, in that case, we don't really have the trade-off between relevance and reliability. All right, and then just two others here, and then we're going to get into recognition and measurement principles. Actually, I mean, I kind of have a problem with these in a lot of ways because, you know, I really wouldn't hold you to this, but I guess you'd have to know this for CPA purposes. Comparability is where you can compare two companies in the same industry, and consistency is when you're comparing the same company over time. So when you look at one company, you want to make sure that it is consistent in the use of accounting standards, one company, but comparability is when you look at more than one company over time. Now, for me, if I want to look at one company, 2016, 2015, I can say that's comparable as well, but they like to use the word consistency. All right, so consistency, it enables you to compare one company over time, going up on top, comparability, comparing two companies in the same industry. All right, so that takes us through, and again, I'm just over, we do much more on this in intermediate, but we understand the objective of financial reporting, and now those are the qualitative characteristics, and we'll conclude this, and then we should get right to the break, recognition, measurement, and valuation principles. And these guide day-to-day practice, and these are the assumptions, principles, concepts, and you can't really hold me to those terms because some books call them principles, some books call them assumptions, some call them concepts, but they are the underlying foundation for building financial statements. Separate entity concept. Now this is something that you would have to invoke for a partnership or a sole proprietorship. Corporations are already a separate entity. But you still may need the separate entity concept there as well. So basically what we do is when we're accounting, first of all, you have to know what is the entity we're accounting for. And then secondly, making sure that that entity's transactions are separate and distinct from owner transactions as well as transactions of other businesses. Now, this separate entity concept could be misused in a lot of ways. Because all I need to do is create a new entity, and I might be able to keep it off balance sheet. That's been a big problem. That was Enron. I mean, if you look at, someone said they went to a seminar trying to explain the Enron, structure before it was, taken down, and there was so many entities separate from Enron itself. All you have to do is set up a separate entity, move management, have the management work on that company, and you could have transactions between them. I mean, if you look at, and they didn't have to be consolidated. Now we're consolidating more of these entities because of Enron. We're now, it's harder to keep these entities off balance sheet. But what do you do, for example, we got baseball season, the Yankees played the Rockies this week, is that right?
Yeah.
Yeah, okay. So let's just say, and they're over at, Coors Stadium, right? So, yeah, Coors Field. So, who owns that? That's okay. I mean, who owns Coors Field? Or the family that owns Coors, is it the same company that owns the beer? Okay, so they're separate entities, I'm sure. The baseball team and the part of the family that owns the team is separate from the brewing company. Do they serve Coors beer at the stadium? Anyone know that? I would think so.
Probably.
So yeah, so the question is, when those transactions are conducted, do we consolidate them or not? But if we don't consolidate them, we have to be very careful. What if the beer company, the brewing company, wants to show higher profit? They could sell beer to the stadium at a markup of, 200%. And by the way, we pay that much, I think, for the beer anyway. So they can mark it up, and that could shift the profits from the brewery to the baseball team or to the stadium. So when they're separate entities, you have to be very careful because sometimes when you invoke the separate entity concept and these entities are not consolidated, then you have to look at the transactions. A related party, that was known as a related party transaction. That's a related party transaction. And you have to be very careful when you have related party transactions. You have to make sure that they are arm's length. You have to make sure that they are properly valued if the companies are not consolidated. Another issue that we'll see a little bit of in this course, a lot of in intermediate and advanced accounting, is that what do you do if, and again, we're just throwing out lots of ideas in this first couple of weeks, but especially this first chapter. What do you do if you're looking at Coca-Cola or PepsiCo and they own 40% of bottling companies? Do they need to consolidate? When do you consolidate? Does anybody know? How much stock do you have to own before you consolidate a company? Generally, there are some exceptions. We'll talk about those as well at some point.
50% or more, maybe?
Over 50.
Yeah, over 50.
Over 50. So why do you think Coca-Cola and PepsiCo buys up all these bottling companies? 38%, 40%. They don't consolidate them, but do they control their operations? Where do the bottlers get the syrup from? Coca-Cola. So all of the activities of the bottling companies are generally not consolidated. Now, there are some cases now we are bringing them on balance sheet. But an example would be if, and I'm not saying that the bottling companies do this, but what you could do is have the bottling companies borrow lots of money, expand their operations, and buy more from the beverage company, and the beverage company sales go up, but the debt is sitting off your balance sheet. So these are entities that are kept separate, but we have to be very careful. And today, more and more, we're finding that the accounting standards are addressing this issue very heavily, and they're moving more and more of these entities on balance sheet, even if they don't own more than 50%. So you're going to find that we consolidate more companies today with under a 50% ownership because of that beneficial relationship that we have. So I just want you to think about the separate entity concept that, in general, in a basic 101 course that you might have taken, the example is, well, the owner goes out and has suits dry cleaned, and they put the bill on the company's, that kind of stuff. It's actually much broader than that.
If a company owns over 50%, they have to consolidate or they can consolidate?
Under US GAAP, it has to consolidate.
Okay.
Yeah, and for tax purposes, it's up to 80%. You must consolidate at the 80%. Well, not must, you have the option for tax purposes to consolidate at 80%. For GAAP purposes, over 50. You consolidate. Under 50, you generally don't consolidate unless the relationship is such that you are what they call a primary beneficiary. So if you're able to really control the company as if you own it, we now bring them on balance sheet a little bit more than we did in the past.
Okay.
So you'll see all that. But I'm not worried too much about those other entities right now. I just want you to think about this concept and realize that if you keep companies separate, you have to think about the possibility of related party transactions. So what's the relationship of a company that owns 38 or 40% of another company? It's not consolidated, but what's that business relationship? We do keep them separate, but maybe there's something there that we have to think about. Are we marking up our inventory? Are we shifting profit between the entities? And that's the question. All right. Going concern. This one is actually used every single day. Unless you have evidence to the contrary, you will view a company as having an indefinite life. Not an infinite, but an indefinite life. So when you look at the company, you're going to say that it has a life long enough to carry out contemplated operations, to use up productive capacity, and long enough to pay off its long-term obligations, unless there's evidence to the contrary. And the going concern means that the company has an indefinite existence. Now, whether you know it or not, we talked about how the conceptual framework, you will know it now, guides day-to-day operations, although people don't walk around and say, oh, you know what, I've got a building, it's going to last 40 years, I'll depreciate it for 40 years. That's really using the going concern concept. Right, because you're actually saying implicitly that if you depreciate a building for 40 years, you're saying that the company's a going concern. On the balance sheet, when you classify debt as current or non-current, long-term debt is implying that you think this company's a going concern. If a company is not a going concern, it goes into bankruptcy, and everything is current because you're going to sell everything off. So there's no long-term. So the going concern concept does justify depreciating buildings for 40 years, the long-term or short-term classification on the balance sheet. Any questions on that one? Right, even when we make projections, even financial analysts, when they make projections, you're invoking the going concern. Okay, the accounting period or the time period assumption, this basically is what we were saying before. This is sometimes called the time period assumption. This is where the life of a business is artificially truncated into smaller periods of time. And those smaller periods of time become your reporting periods. Now, If we didn't have the time period or the accounting period assumption, accounting would be very easy. Because we would just kind of hang around for like 15, 20 years, shut the business down, and we'll figure out how much they made. The problem with the time period assumption is that once you start separating the business into these periods, these are artificial periods, when you start separating the business into time periods of artificial length, we have to have a cutoff, and we have to try to measure a transaction for that period. So for example, if you had a utility bill that you didn't get, this is 2016, you receive a utility bill in 2017, some of that applies to last year. What do you have to do? You got to take a piece of that bill and allocate it back to 2016. So you have to cut transactions artificially. And that's what makes accounting a little bit more difficult than it would be had we just let the business run its course. So the time period assumption requires what we'll see is known as accrual accounting. Accrual. And then finally, measurement unit, that's pretty simple. Just basically tells you that you've got to measure transactions in terms of the monetary unit, and in the US, of course, it is the dollar. All right, and finally, the last measurement principles are going to be cost concept or principle. And basically, this is the primary driver in US GAAP, in most countries as well. I will tell you that prior to the stock market crash in 1929, market values, current values, fair values were prevalent in financial statements. Market crashed, SEC put into place in 1934. The argument was speculation, use of market values, too subjective, never again. We're never going to use market values again, and we now use the historical cost concept. So all of your assets, liabilities, and even stockholders' equity will be, for the most part, with some exceptions, will be measured at cost. They'll remain at cost until they're used up or consumed or sold in the operations of the business. The historical cost is objective. It's faithfully represented. It's verifiable. It's neutral, subject to verification. It has all the qualities, based on an arm's length transaction, which means a transaction between a willing buyer and a willing seller negotiating for their best interest. So it has all of the qualities that you would want in a measurement, in the sense that it is, reliable and it's faithfully represented. It may not always be the most relevant, right? Because you've got a building and you bought that building in 1940 and it's still on your balance sheet at the same price you paid in 1940. So it's not quite as relevant, but again, all of us would verify it. We'd have the mortgage and the documents, and we'd all agree that that in fact is the historical cost. Now, again, we do have some exceptions, and for the most part, for most assets and in most industries, cost is the ceiling on asset valuation. So when we look at for most assets in industries, not all, for most, cost is a ceiling on the valuation of an asset, the measurement of the asset. Now, if the market value declines, and it is other than temporary, we could write it down to market. We could mark it down to market value. And that's known as an asset impairment. If an asset's impaired, we write it down to market. We do not generally have recoveries, but if there is a recovery, If there is a recovery, you cannot value the asset above cost. If there's a recovery. So, if market value recovers, in some cases we'll see, we're going to be covering a lot of ground in the next 14 months in terms of all these standards. So we will see cases where they do allow recoveries. You cannot go above the original cost or the original carrying value of the asset. You can recover, but not above the original amount. That's one part of the measurement principle. It's the cost side. And by the way, a lot of people will tell you that going concern is a way to justify historical cost, because we'll move to market value in just a second. The typical argument that you will see to justify historical cost if an entity is a going concern, then productive capacity, productive assets are not for sale. Market values are not relevant. And therefore, you should use the cost valuation. So sometimes going concern is used as a way to validate our use, extensive use of historical cost. Companies are going concern, you're not going to sell off its plant, right? I mean, if you started selling off all its plant assets, you're not going to operate. Therefore, market values for things like buildings, land, equipment, not relevant to anybody. If it's not going to be sold, then that might not be a valid argument, but I'm just telling you the way you might see this, and therefore, cost becomes the valuation. Cost becomes the method of value. Okay. All right, so that's the cost concept. Now, we do have exceptions, which I'll show you in just a minute. We do have a fair value principle that we do use in US GAAP as well. Before we do that, any questions on the nature of historical cost? Again, it is the primary valuation for most assets and industries. There are some industries, a lot of you do go into financial services. Years before we use fair values on our balance sheets. Insurance companies, financial service companies always used fair values for their investment holdings, their portfolios. So it is industry specific in many cases. Okay, now the last concept is the fair value principle. And this is something that started as mark-to-market accounting, as it was called. The fair value principle is used in the United States for investments in equity securities and derivatives. So we do use fair values for investment securities with readily determinable fair values and derivative securities. There's also something known as a fair value option, which we'll talk about a little bit. When you think about fair value, the fair value cost or principle or concept in terms of measurement, it makes a lot of sense for something with a quoted market price, because when we, and by the way, when you use fair value, under the fair value concept, when we mark to market, there's no ceiling. So in the fair value principle, there's no ceiling. So we can mark it up above cost, and then it fluctuates. Now, there is, obviously, as I said, some justification for that. But let me just make sure. So when we look at fair value, we have quoted market prices, and that's probably, and it is the most reliable, most faithfully represented. Get a New York Stock Exchange quote. You got market comparables. What's market comparable? Does anybody know? Yeah.
Like if I had two homes, I could compare them to one another?
Yeah, exactly what I'm going to say. I was going to use the house example, but yeah, comparable. I mean, for, how do you know what to sell your house for? Look down the street. Somebody just sold for $400,000. My house is pretty much the same. I should get about that as well. In the securities world, a market comparable, you would look at similar characteristics of the security, very much just like a house, right? How many rooms? You'd look at the companies and look at their similarities. What characteristics of the companies are similar. And then, of course, you have estimation models that we could use, and these are based on management's assumptions. Now, we'll see later on, again, and I don't keep asking, so I guess a lot of you have not seen financial statements yet. But one of the things you'll see on your internships, especially if you work in financial services, we now have a footnote to the financial statements, and we'll let you know how they measured their financial instruments. And that gives you some sense of the reliability. Which one of those is the most reliable? Quoted market prices. And what's the least reliable? Management's model. So actually, these are ranked. So these are known as levels, level 1, 2, and 3. So if you're looking at a footnote and you see a level 3, what does it tell you? Well, they're carrying something at fair value, but it's not as reliable as it would have been had they had a quoted market price. So we will disclose that. And that really gives us lots of, I guess, in a way, I wouldn't say confidence, but at least it gives us a way to use fair values that makes the profession a little bit more comfortable in doing so than just disclosing the fair value. We let you know how they are measured. So these are level 1, 2. All right. Now, if you have any questions, we'll get to them now. And I want to ask you a couple of quick questions and then we'll break. But does anyone have any questions on cost versus fair value? And I just wanted to make sure you have some exposure to the conceptual framework, at least early on in this semester. Now, 3 more questions, and then we're going to start getting into what you might have thought accounting was before, like lots of numbers, and we'll do that in just a minute.